Hey, welcome everyone. Thanks for tuning in to another presentation here. My name is Tim Racette, and I blog over at eMiniMind, and we'll be talking about Fib retracements as they pertain to the E-mini futures. So lots of good stuff to go over in the next hour. The presentation, just like all the presentations, is being recorded, so you can take notes, but you also get a copy of the recording afterwards. So we're going to talk about a lot of different stuff, everything from kind of trade execution and trade management to some of the mindset and psychology side of trading. As you can kind of infer with the E-mini Mind name, part E-minis trading, part mindset and kind of trading philosophy is kind of where I like to come from. And we'll go over a lot of different things, but we'll kind of try and stay focused strategy wise as it pertains to Fibonacci retracements and things pertain to the futures markets. So you'll be able to take the concepts. If you don't trade futures, if you trade stocks or options or other markets, you'll be able to take the concepts and transpose them to other markets. But from an example purposes standpoint, we'll pull a lot of examples from the E-mini futures and things like the E-mini S&P. So what we're going to go over today, kind of in a nutshell, before we get into the nuts and bolts of everything, I'm going to go through kind of three main pieces of my trading strategy that you can either kind of use in their entirety or just kind of pick bits and pieces and kind of add them to your trading. A lot of people tend to kind of pull the trade management pieces that I'll talk about and kind of incorporate them into their own setups or kind of trade execution. So don't feel like you have to kind of go all the way back to the drawing board and start over. You can pull bits and pieces, just like from all the presenters that we've had today in the last couple of days. You can pull nuggets of wisdom and bits and pieces of their strategy and incorporate it or test it out in your strategy. Sometimes taking too much and kind of morphing it all into one can be a bit of an overload and a detriment. But if you can be selective and if there's certain pieces or ideas that resonate with you when you're listening to a presenter or reading a book and things like that, those are the things that are really worth going deeper on. You don't have to implement every single piece of information that we're going to talk about today. But we're going to talk kind of in general about halfway backs or Fib retracements is kind of the theme of today's group of presentations. We'll talk about some ways you can kind of optimize your trade. So kind of regardless of the entry that you're using, some things that can help you, decrease your average or kind of bring down your average losers and bring up your average winners. So you can kind of increase that spread or that expectancy for your trades as a whole. And we'll talk about some specific trail stop techniques that I like to use that you can probably implement kind of regardless of whether you're trading futures or stocks or even options. There's some things that you can do as kind of a general framework to help in large part, like on a psychological level, to know that, okay, regardless if the trade ends up ripping or if the trade just ends up going, 4 or 5 points and then turn around, I'll be able to manage the trade the same way every time so that I'm not stuck kind of on the back foot thinking, well, what did the trade do what did the last trade do? And I'm going to manage it how I wish I would have on that trade. And then you do that, and the next trade is completely different. So we'll talk about some specifics when it comes to trail stops. And I always like to kind of start from a big picture or holistic approach and kind of, the whole reason that we're here trading is to gain that freedom, that flexibility, to have a truly free kind of go anywhere, do what you want, when you want lifestyle. And so, there's a lot of hard work that goes into trading. Obviously, that you're here because you want to improve your trading, and whether you're trading, futures, stocks, options, forex, the the concepts that we'll talk about can be applied to all of that. But the bigger idea of kind of creating a career path or kind of an income stream that you can do on a day-to-day basis in kind of a truncated time block so that you're not stuck sitting in front of the screen all day long. And when you're not in front of the screen, you're stressing over trades that you have on or trades that you took that you wish you didn't take. Kind of creating this lifestyle that gives you the flexibility, but when you're, in front of the screen, you're focused, you're trading, and then when you're not in front of the screen, you're not kind of consumed by woulda, coulda, shouldas, and the trades that you might have on. So that's kind of my angle for trading. It's like, how can I develop a lifestyle that allows me to do the things I want and go the places that I want to go on my own time? So whether you like golfing or if you got kids or grandkids or, hiking, biking, things like that, that's kind of if you keep that as the objective in mind, then that kind of acts as your North Star, if you will, or when things get a little bit rocky, then you can kind of have that as your reason why you're trading. It's not just to go from a 9 to 5 job to, be trading 9 to 5. And even if you were, keeping the same relative income, it's like, well, the idea here is to shrink the time that we're working and in some ways kind of be able to scale ourselves or scale our trading so that we're not directly trading dollars per hour. We can scale up in the number of shares we trade or the number of contracts, whether it's futures, forex, options, any of that. So there's a lot of benefits to being able to trade and build a nice life. So, it's really perfect for anyone who is, if you have whether you're a beginner or a, seasoned trader, if you're not super consistent or you want to be more consistent and kind of, either continue to trade part-time or become a full-time trader, the stuff that we're going to talk about today can kind of help fit the bill, whether you're trying to go from pure switching a career into making trading your full-time income, or if you're retired and you want, a little bit of side income, or if you just, like the challenge and pattern recognition of trading and trying to build in a lifestyle that allows you to have time to do other things outside of trading. So for those that are familiar with me, you've probably been over to eMoneyMind.com and read some of the various articles and things that I've put out. But if you're not, if it's your first time tuning in, thanks for being here. Like I said, my name's Tim Racette, and I've been trading since about 2006. And I got my start back in Chicago. I was kind of lucky or fortunate enough to grow up in the Chicagoland area and have access to both the trading floor, the Chicago Board of Trade, and the trading pits, as well as other traders that were already trading on the screen. It seems early in the 2000s to be thinking about computerized trading and stuff, but really in the late 70s and 80s there was already computerized trading going on, and lots of things happening outside of the trading pits. By the time we got down there in high school, you're talking, the pits are shrinking and there's not as much activity in kind of a live trading environment versus on the trading screen and the computer and things like that. So kind of a bit of being in the right place at the right time and having some good mentors really helped me along in my trading career. I primarily day trade futures. I did get my start to kind of the stock market world with swing trading stocks and kind of holding overnight and trading individual stocks. But primarily, I day trade futures now at this point. And I've had the pleasure of speaking at a number of both David's events here, as well as Traders Expos and in-person events like that. So always nice to get out and chat with other traders, because if you're at home, trading on your computer in your home office, it's kind of lonely, and there's really not many people that can relate. Sometimes it can be really helpful to, get a mastermind group going, even if it's not with other traders. You might have a real estate broker or someone who, sells trinkets online on Etsy, and kind of entrepreneurs and things like that who want to get together. That can be super helpful. I got together with some friends through college and after college. We kept it going, and that was very motivating. And you curate a lot of good ideas in that kind of environment, even if they're not traders. Just being able to kind of be around people who are not necessarily the traditional 9 to 5. I always dreaded kind of talking about trading, or people ask what I did. And it's like, oh, well, I trade the markets. It's like, okay, well, kind of explaining what that is can be a bit of a daunting task. So if you can surround yourself with people who also kind of think outside the box, or are not just tied to a 9 to 5 job, mentally, it can be super helpful. And if you can find a trading buddy, someone, whether they're local or someone you connect with online or in a forum, it's super helpful to, even if you're one person's trading options, one person's trading futures, just the fact that they can kind of relate to the psychological struggles and challenges that you might face, to be able to, go grab a drink and talk about your trading on a Friday afternoon, how the week went. That was super helpful for me. I'll try not to talk too much, Ray. So, outside of trading, though, I like to get outside and ride my mountain bike, and spend time away from the screen as much as possible. So to kind of keep things rolling along and not talk too much, we'll just dive into my trading style and routine, and get to kind of the meat and potatoes of the presentation. So over the next, what do we got, 45 minutes or so, that'll be plenty of time. We're going to talk through kind of the way that I trade, and the executions, and some kind of very specific things as well. But we'll start with the trading routine, and then we'll dive down from there. So with trading, really less is more. You can have 5 monitors and 10 charts on each monitor with 1,000 different indicators, and all that on your chart, but it will, at the end of the day, make it more difficult to execute trades. Whereas if you can simplify, bring your trading down to one main screen, and maybe one like a second monitor where you have your trade log, and I have my charts on one screen, and then my trade log and my trade ladder on another screen. And that's kind of what I've done for years and years and years, and I find that super helpful. It's clean, nice and easy to execute off of. And you want to spend a lot of time investing in your mindset, and being able to kind of be very, well, mindful, but be very focused when you sit down to trade. And so if you can shrink the time window that you're going to trade, that can help limit your losses just from a opportunity to trade standpoint, but it can also help increase your focus. If you know that you're going to be focusing for 2 hours in the morning, that's your trade window. You can come in, you can be focused. It's a lot less daunting. I kind of come to trading from a bit of a kind of like professional cycling background, and like high level athlete perspective. And so with any athlete, you're going to have rest seasons, an off season, rest throughout the season. And when those breaks are coming, and that time of kind of refreshment is coming, it makes it a lot easier to sustain for years, year after year after year, and you don't get burnt out as easily. So getting outside, away from the trading screen, is actually super helpful. And your big ideas or your light bulb moments are not going to happen when you're sitting in front of the screen. It's going to happen when you're kind of, maybe you're banging your head against the wall, frustrated. Then you get outside, get away from the screen, let your mind process in the background, and that's when a lot of things will start to click. So I also really like reading, whether it's not necessarily trading books, but just reading in general really helps kind of get the mind, get those creative juices flowing. So like we talked about just a few minutes ago, trading is a means to an end. So figure out what your end is. What is your goal from trading, and what are you trying to, on a long-term basis achieve? And then that will help your day-to-day, keep pushing you forward. And then you can kind of go backwards. If your goal is to win the Olympics, you can't just wake up every day and think, okay, I want to win the Olympics. You got to work backwards and say, okay, how am I going to qualify for the Olympics? How am I going to go, the step before that, the step before that, and then what is my objective today? And you can break it down to kind of the smallest means. And so if you want to be trading, if you kind of do crunch some numbers and you decide how much money you need per month to live, and you decide, okay, I need to trade 10 ES contracts, or I need to make, 20 points a week times 10 contracts, you can kind of break it down into, okay, in order to get there, I need to be trading 5, 4, 3, 2. Kind of newer to trading. I'm not quite, comfortable trading 2 ES contracts. I'm trading the micros. So you can kind of work backwards and say, okay, I need to get 50 micro trades and gain some consistency and some confidence in my trading before I can step up to trading the minis. And then kind of you have that process in place, and then it makes it a lot easier to just be focusing on that. Okay, today I'm just going to work on managing my stops, making sure that I keep them, where I start them. I'm not going to be deleting a stop or making it wider and things like that. Then you kind of check that habit off. Okay, cool. I got my stops figured out. Now I'm going to work on, trade management and just kind of the next thing and the next thing. If you pick one thing a week to work on, you can get really good really fast. So things like design your lifestyle to free up more time and whatnot. Those are all good things to kind of reduce stress so that you can be very focused in your trading. If you've got, 4 or 5 kids and your house is just complete chaos, it's going to be a little more challenging to be focused and trade in the morning every day, depending on what time zone you're in. And then the other thing is, kind of going from the holistic approach, just having goals and also having like positive affirmations of things that you want to be. That can really help. Sometimes it seems a little bit hippy dippy or fluffy, but that kind of stuff and keeping the negative thoughts out of your mind or reframing some of that and always focusing on, okay, if you had a losing day, find one good thing that you did in your trading that day. And one thing that you wish you could have done better to take away into the next day. And if you keep moving forward in little increments like that, a 1% improvement a day, it only takes 100 days to be 100% better. So the first piece of kind of trading chart wise we're going to talk about is the tick chart. I use 1-minute chart, 5-minute chart, but the other type of chart that I like to use is the tick chart. And the tick chart is just instead of a time based on the x-axis, so like 5 minutes of time and then the candle closes, the tick chart is based on a number of transactions. So when it comes to day trading, this gives a little bit more visual data, but also helps visualize the volume, because instead of an amount of time occurring, 5 minutes and then a candle closes, 15 minutes and a candle closes, this is going to close, the candles are going to close after a certain number of transactions. So I use 512 for ES and NQ trading, and after 512 transactions, the candle closes and the new candle starts. So if you are trading at the open, you're getting candles closing really, really fast, forming and closing fast. If you're look at the markets, after hours, Globex session, it's going to take a lot more time for those candles to form. And it's a really good way to kind of break up the day on kind of a micro level. And if you're only going to be focusing on the morning NYSE open for your trading, where most of the volume is occurring, and you've kind of got the overlap between the European session and the New York session, the US session, that's where most of the traders are active and where most of the activity is happening. So you can, if you're looking at an hourly chart, you're going to have very few trades, even over the course of an entire day. Whereas if you drill down to a smaller time frame, it's going to give you a lot more opportunities. And the 512 is kind of the sweet spot where it's not just a bunch of noise. It's more of like a way to smooth out some of the noise. So, yep, sorry for talking so much. We'll try to speed along and just get you out of here. So, looking at the tick chart, if you look at a tick chart side by side with a regular chart and take away the x-axis, it's going to be pretty much the same as far as what the chart looks like. It's just the time component is a little bit different. So sounds like you guys just want to look at the charts, and I'll quit talking and just show the charts and jump on out of here. So the first thing you want to do is look at identifying the trend. And so the important key areas of the chart to look for are swing highs and swing lows. So if you print out like a 5-minute chart of the ES, you can just go through and kind of mark swing high, swing low, and you can kind of start marking the trends as far as just kind of like the basics. When you go into football every season, you're looking at blocking and tackling. I'll try not to use too many analogies. We'll just stick to the charts here. But you want to look for breaks of swing highs and swing lows. You can do this in a daily chart, intraday chart. That's going to be super important for identifying the trend. And more importantly, the trend changes, because you want to know, whatever strategy you're trading, are you trading in a trending market, up, down, or are you trading in a sideways market that's range bound where you don't have, consistent follow through with the trend? So most of you are probably familiar with all the basics. Fear and greed, all those emotions are just human behavior. Uptrend, higher highs and higher lows, downtrend, lower highs and lower lows. All the basics we probably don't need to go over. But if you really simplify your chart and take off a lot of the indicators and all the other garbage on the chart, it makes it a lot easier, ironically, to see the trends just based off of a break of a swing high or a swing low, and seeing higher high, higher low over and over again, regardless of what time frame you're on, is going to give you a kind of definitive signal, a very objective signal that, okay, we are in an uptrend. So the most important component of identifying the trend is identifying that point where the trend is changing. And so if you are in a series of lower highs and lower lows and you get that break of a swing high, so you're moving down, you get a break of a swing high, that is going to be the potential start of a new trend. And so when you pull back into and you start making higher low, higher high, higher low, higher high, now you started that uptrend, and getting into the trade at the earliest point in the uptrend is what you want to do. So when we're talking about Fib retracements, or also called halfway back, what we want to do is be looking to enter at the 50% retracement level. And so 50% is not really a Fib number, but it's just from a basic perspective of, we identify we're in a downtrend, let's say, and the market bounces up to the 50%, then that's where we want to look at getting into a trade with that initial trend. So even though the market is going up, is bouncing up into the 50%, the larger trend is down. So when you're drawing Fib retracements, you always want to draw from the left to the right. And when you identify the larger trend being down, you don't want to get caught up in thinking, oh, we're bouncing, now I have to get long. You want to keep that larger trend in mind so you can be actively putting on a short as the market is going to be rolling over, and you're kind of a step ahead or 2 steps ahead of the rest of the traders that are kind of just chasing things. Oh, market's going back up, we gotta jump in long. Oh, now it's going back down, I just got stopped out, gotta jump in short. So you can use just a basic Fib retracement tool and draw from any kind of swing high to swing low. That's where the swing highs and swing lows are so important, to be able to identify those, so you can use those as your anchor points and just kind of continue with the trend. When you're in a downtrend, you're drawing up shorts. When you're in an uptrend, you're drawing up longs. And so using the 50% retracement on the ES, I like to use a 2-point stop. And it seems kind of tight, but when you're on a 512 tick chart, that's plenty. When you identify the larger trend by looking at like a 5-minute or a 15-minute chart, you can just jump in on the 512 tick chart for your entry. So you can kind of use a larger time frame as getting the bigger picture of the overall trend. And even, a 5-minute chart is not a huge time frame, but it's a lot larger than a 1-minute or a 512 tick chart. And so when you see that the larger trend is down and you zoom into the smaller time frame, you can kind of take a lower risk entry point on that 512 tick chart, and then a 2-point stop is not a big deal. So let's talk about some ways you can kind of optimize your trade for the least risk, most reward. So the idea is to stay in winning trades longer. And as the trade is going your way, you kind of want to swing the bat with the same effort every single time. Sometimes you'll connect for a single, sometimes you'll connect for that home run. And it can be difficult for an individual trader to just get rich hitting singles and doubles all day long if you end up taking losses that are the same size as those singles and doubles. And so if you're kind of at a 1-to-1 reward to risk, by the time you get commissions, taxes, and all the other things that go along, it can be difficult to really get ahead. So having those home runs, maybe they only come a couple times a week, that really kind of gets you over and increases those margins. So I find it important to kind of reduce risk early in the trade. So I always go all in. I know some people like to scale in. I find that, my best entry is going to be my earliest entry. And so going all in and scaling out has always been my approach. And I find it really helpful to split the trade in half. And so what you can do is, using that 2-point stop, use a 3-point target on the first half of the trade. That way you're kind of getting that quick win. It's still more than 1-to-1. You're not going to get rich taking 3-point trades unless you're trading, really big size. But the idea is to get that quick win so that mentally and emotionally you have the bandwidth to sit in the trade to get that larger win by trailing the second half. And so if you're sitting in a trade with a full stop out, still at risk of a full stop out, you might get nervous. You might just say, oh, I'm up 2 points, I'm up 4 points, but my stop is still -2. So if I'm up 4 points, that's 6 points away. I don't want it to come back. I'm just going to close out the trade. And if you only have a couple of contracts, you don't really have much opportunity to scale out. You take 2 contracts off, and if you only have 2 contracts, you're out of the trade. So taking a smaller first target on whatever trade setup you're using is a really good way to help stay in those trades longer. So I'll even do this when I'm trading options. I'll tend to buy puts to hedge a larger position. I mean, kind of the hedge fund 101. And if we get a big drop in the first day or two, I'll sell some of the puts, lock in some profit on the trade, and then I can kind of sit back. And if we keep going, great. If we, don't do a whole lot and it doesn't materialize any more than that, I can close out the rest of the puts for, even if that half of the puts or that section of the puts ends up losing a little bit of money, I've already taken a profit. And so I can just walk away, break even, free insurance and move on to the next trade. So the second half of the trade is what I like to trail. You could do it in thirds, like you could break up the trade in odd numbers, but for simplicity's sake, it's just nice to use even numbers. Or if you're trading shares, 400 shares, you split it into 200 and 200. If you're trading ES and you're trading 4 contracts, 2 and 2, just makes it easy. Because when you're, setting up bracket orders and things like that, or just even, sometimes the trade ladder can move super fast, and it's helpful to just kind of keep things as simple as possible so you don't make any mistakes with your trade execution. So if you're using bracket order, you can just set a 3-point first target, 2-point stop. Some platforms allow you to not have a target for that second half. It's just kind of open-ended and you can just trail your stop. Other platforms, you have to put in a target for the second half. Then after the trade executes, you can just delete it and then kind of have an open-ended trade. So you're not so you don't have this limit order sitting out there, this kind of target order sitting out there that you really don't need. So the trail stop technique that I like to use, or two techniques that I like to use, both for intraday, futures trading or swing trading, is to focus on trailing that second half. So if you're in a downtrend and the market breaks a swing high, so now we're at the potential of that downtrend failing or being over. Maybe you come down to a support level. Maybe you gap up on the day and you start selling off, and then you fill the gap. So you trade at yesterday's close, and now you start to break the swing high, start to bounce. You get some support at that gap fill. Now you can buy the pullback at a 50% level, 2-point stop on the ES. You might use 20 ticks on the NQ, something similar to that $100 per contract, 10 ticks on the NQ. When you look for that as your entry, the 50% as your entry, 3 points on the ES is pretty attainable, even on a super low, even if VIX is down to low teens. That's pretty easy to get a small move like that. And so you're not thinking about like getting that home run. It's just, okay, got the order out there, 3 points is hanging out there. We can get that hit. Now you're essentially in a free trade. Even if your stop was at -2, you're going to walk away with, a small profit on the trade. We'll just call it scratch up a point. But when trailing the second half, there's a couple things that you can do. You can trail the next 61.8 level. So that's going to be a Fibonacci level, 61.8. And you can just draw up the next retracement and then put your stop underneath that 61.8. And then once you kind of move up, make a new swing high, pull back, you can draw the next retracement and just keep trailing the 61.8. What I really like to do is trail swing lows if I'm long. And just as soon as we make a new high and pull back, make another new high, just bring the stop up underneath the swing low. This works super well on daily charts, especially when we're in low volatility environments and you get in some of these kind of bull trends. It's just like rally, pull back, and just keep trailing those swing lows. And once again, the swing low is dictating the trend. As long as we're holding the prior swing low, higher high, higher low, higher high, higher low, all the basics there, you can stay in that trend. And so if you're long, trailing swing lows, if you're short, trailing swing highs. And the third option, especially if the market gets moving super fast, you can trail each candle. And the trailing each candle, it could be a daily chart. Intraday, it could be something as small as the 512 tick chart. And when you do that, it helps keep you in the trade longer versus just kind of panicking, hitting the flatten button or hitting sell market. You can just kind of look at the low of the candle, move your stop 1 tick below that. And, the candles can be forming fairly quickly. So you're just kind of moving your stop up, 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 up until the prior candle gets broken, and then you get taken out of the trade. And that's going to give you a much more open-ended profit potential. And so you might start the trade. A lot of times, like if you trade the ES especially, you get into the trade and it's kind of a little bit slow to get going. And then once you get away from your entry a little bit, or maybe you break a swing high or break new highs on the day, all of a sudden you can start ripping. You'll see it a lot to the downside. You start kind of selling off, and then all of a sudden you nosedive and you're dropping off a cliff. And instead of like freaking out and being like, oh, should I set a target at 10 points or, what do I do? Having a plan for if it's moving slow and you're selling off, lower high, lower low, lower high, lower low. Just put your stop above the swing high, and then let it move down, gets a little bounce, rolls over again, move it down again. Pretty methodical and easy to just look at the chart and trail your stop like that. And then if all of a sudden you really start ripping and it's like new low, new low, new low every single candle, just trail each candle by a tick or two, and that will allow for the trade to like keep running. And as soon as it starts to lose that momentum or change direction, then boom, you get out. And sometimes, especially the ES, when we're in these, I wouldn't call this high volatility, but for those who started trading over COVID, this is probably the most volatility you've ever seen, minus the 2020 drop. And so you can get, a 10, 15 point move in a matter of minutes sometimes if we're in, VIX mid 20s. For those that are around like 2008 and before that, even like the mid teens, there were some pretty volatile years, and you'd have a lot bigger ranges, which yield a lot more action and speed at which the trades are forming and taking place. So another thing I want to talk about, if you're trading the ES, the nicey tick is super helpful. And so it can get a little bit complicated at first as far as looking at the nicey tick and trying to make sense of it. So this is how I have my chart set up. On the left side, I'll have like a 5-minute chart. On the right side is that 512 tick chart. And then the bottom left, I have that nicey tick. So between the word tick being in the 512 tick chart and the nicey tick, along with just kind of making sense of the nicey tick itself, it can be a little bit confusing. But the main concept with the nicey tick, this would be mostly applicable if you're trading the ES or the NQ. You want to be looking to buy in low ticks and sell in high ticks. So the nicey tick is essentially giving you the net number of stocks that are all moving up versus down on the nicey. So you got roughly 2,500 stocks. A high tick number of like 1,000 is going to be telling you, well, at least 1,000 stocks are moving up. Some could be moving down, could be just unchanged from their last print, but at least 1,000 are moving up. It's probably not sustainable for them to keep moving up all in the same direction all at once. So you're probably going to get a bit of a snapback. And so that also helps kind of pinpoint entries, use that small, relatively small 2-point stop. For some, that might not be small, but when you're talking, the ES, that's probably small for most people. And buying in low ticks, selling in high ticks, it doesn't necessarily have to be the lowest tick of the day, but whenever I'm about to place a trade, and with Fib retracements, you're probably mostly using limit orders. You're putting your order out there, you draw up your retracement, you put your limit order out there at the 50, and you let it come down. If you're looking for a long, let price come down to your order. So you get good fills. And as the price is coming down into your order, I just glance over at the nicey tick. Okay, cool. Nicey tick's coming down. Boom, we're in a low tick. We're about to get filled. And then, getting filled, stop goes out there, 3-point target, and then you can kind of let it run. And that will help by using the nicey tick. It will help prevent you from kind of getting in a trade, then just having it blow through your order. And so like a freight train, just kind of run into your order and then get blasted and hit your stop. So that's a really good one. Nicey tick. If you're using the trading the NASDAQ, there's a NASDAQ tick. So a lot of times $TICK on most platforms will pull up the tick data. If you put a /Q, most of the time that will give you, at least on Thinkorswim, it does give you the NASDAQ tick. And same concept applies. It's just using the stocks on the NASDAQ. If you're trading Forex, you really don't have any tick data, which in some ways makes it simpler. If you're trading stocks, you could trade the SPY in exchange of the ES. You could, be doing the same thing on a daily chart. With options, it's actually very it's very worthwhile to trade options in this way with retracements. The only difference is you want to be taking profit on your options when, like, with the momentum. You don't want to wait too long trying to gain more. So if you're buying, whether it's weekly options or daily options, or intraday, like 0 DTE options or whatever, you could be buying calls when the price is coming down. So you're expecting the market to go up, you draw a retracement long, so price is coming down as you're going to be buying your call option. And so, you're getting a better price. If you're buying a breakout, market's breaking out to new highs, and you are trying to buy calls, now you're paying a premium. The price is going up. You'll have, a little bit of drop in implied volatility, just because most of the time when the market goes down, volatility goes up, and then when the market goes up, volatility is going down. And that's one reason I mostly buy puts, because as the trade is going your way, you're also getting an increase in volatility. So you're getting an increase in that contract value just from the implied volatility. But options can be a really good method or approach to be trading, kind of day trading options, if you will, if you don't want to trade futures. The benefit of futures is you don't have the pattern day trade rule. So if you do have a small account, under 25K, you can trade futures. You also get a lot more leverage. Things are very technical. Trading off the trade ladder is really precise. You can set up a trade ladder to be trading options, at least with Thinkorswim you can, and you can kind of trade in a similar fashion. But regardless, it's a good opportunity to be buying pullbacks and buying call options, or buying puts on bounces in a downtrend. So yeah, the S&P 500 tick is essentially the NYSE tick. So there is a S&P tick. I find that just using the general NYSE tick gives you, that's 2,500 stocks versus 500. So you kind of have, in a lot of those stocks, there's overlap as far as stocks in the S&P and whatnot. So the NYSE tick is kind of all encompassing. And so that's why people use it for trading the S&P 500. So to kind of summarize the trade entry, you're kind of getting long at a 50% retracement. If the trend is up, you're getting short at a 50% retracement. If the trend is down, you want to look for those swing highs and swing lows, so that as soon as you break a swing high, if you're in a downtrend, you can be looking for a pullback to get in at the 50%, be very early into the trend. The market has pulled back already, so you're not just chasing it, buying the breakout. And then by the time you're in, everyone else, you're in the trade. And then as the momentum starts to flood in, and you get the late to the party Charlies and other people who are kind of having that FOMO after they see the trend is so clear, then that's when the trade really starts to accelerate, but you're already in at a better price. And so a lot of times, if the trend is so clear, where it's like, yep, we're totally an uptrend, we're going into all-time highs, well, at that point, it's probably too late, and you don't really want to be entering that trade or that trend. But if you have a setup and meets your criteria, the trend isn't incredibly clear, but at least you broke a swing high or a swing low, where it's like, yeah, this could be the start of a new trend. Well, now you're getting in early enough where not a big deal if you take a small loss, but if it is the start of a new trend, you're catching a really big move. So I like to use the 512 tick chart. You could use a 1 minute or a 5 minute or whatever else, but I find that really good for day trading the ES and the NQ. Identifying the trend to start, and then locate those trend changes via swing highs and swing lows. You also can look for larger support and resistance levels. So things like the prior day's high, low, and close are levels that are always going to come into play the current day. I do look at the overnight high and low but the Globex session is going to have so little volume compared to the regular trading hours that I don't put a ton of weight on it. It's kind of nice when you start the morning to glance at the overnight high and low, and you can get some reversals early in the session. But once you start to fill out, 15, 20 minutes into the day and develop a bigger range, um, things like the prior day's high, low, and close have a lot more weight. You can also look at like the value area high, low, and the point of control. Those come into play a lot of times as potential bounce points. So when you're drawing a retracement, having a long that lines up at value area high or the prior day's close just kind of adds confluence. And some traders might not even be looking at the 50% retracement. They're looking at the gap fill. And so you have traders entering long at the gap fill, traders entering long because it's 50% retracement for a whole bunch of reasons. And so having multiple things line up and the extra confluence can be really helpful. Being patient for those swing highs and swing lows is really critical. It can be easy to think, oh, I want to just kind of anticipate the trade or jump into the trend early. But if you don't wait, especially like on a daily chart, sometimes it can be, you kind of get up towards that double top range and or kind of area, and it can be advantageous to want to, jump in short, but and then the market just keeps ripping and it goes higher and higher and higher, and everyone's new high and they're shorting, new high and they're shorting. It just keeps going up, 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 up. You're much better off waiting for that swing low to break and then waiting for the bounce and jumping in short. So you're still very early in the trend. You're just hitting that one winning trade instead of having the winning trade, but following it up with, 3 losing trades because it's like, oh, I'm just selling at highs because I don't think the market can go any higher. And the next day it goes higher. And it's like, well, I'm going to sell again. And then you just kind of take a bunch of losses. And all the winning trade does is then fill in the hole that you just dug. So enter at the 50%, the 512 tick chart. And then once you get in the trade for the ES, 2-point stop, 3-point first target, and then trail the second half of the position. And the 2 ways that you can do that are either trailing your stop by the 61.8, actually 3 ways. Trail the next 61.8, which is kind of nice for starting the trade, giving it the most wiggle room. And then as you start to develop swing highs and swing lows, you can just trail swing lows on the way up or swing highs on the way down. And if it really starts to rip, you can get aggressive, trail each candle, and then that will allow you to lock in, rapid profit as the trade is going or gaining rapid momentum. I don't want to be in a trade and let it go 10, 12 points and then come all the way back down and stop me out. I'd rather take, 8 points of that 10-point move and then put on another trade with a 2-point stop. I'm going to come out much further ahead than having the trade be up 10 points and then come all the way back down to break even and take me out for nothing. So you can make a lot of progress hitting singles and doubles, getting 4 or 5 points in a trade, getting that 3-point first target, and then ending up with 3 or 4 points on the second half of the position. And that can sustain you from, week to week. And then all of a sudden you get a couple of, bigger trades, 10, 15, maybe an occasional 20-point trade. That's like a bigger home run. And then that really puts you over the edge, builds that cushion. I know a lot of people now are trading on like the prop firm or kind of new age prop firm models with things like Top Step and Apex and stuff like that. And so, building that cushion is super, super helpful. Even if you're trading your own money, it's nice to be able to prove to yourself that you can trade with some consistency and build a cushion so that you can take a weekly draw or a monthly draw off your account and not actually be depleting your account at the same time. But those concepts of swinging the golf club the same way, sometimes you'll connect and you'll hit it 300 yards, and other times you won't connect as well and it'll, hook to the left. But at least you're kind of using the same stroke and you're being consistent with your execution, and you're not trying to say, okay, well, the last trade went 4 points and then reversed. So I'm just going to take 3.5 point target and get out of this next trade. Well, then what does that next trade do? It goes 10 points, and you're saying, well, gosh darn it, I should have just trailed the whole position. And so then the next time you get into a trade, you're like, okay, this time I'm going to trail my stop only. And what does it do? It goes 4 points and then turns around. And you're like, well, shoot, I should have just got out for 3 points. And so by splitting the position in half, it takes away a lot of that mental strain, and you're kind of getting the best of both worlds. I will say, like on paper, or like when you run the numbers and just look at your trail stop half of the position, if you only did all contracts, trailed your stop, that will give you a bigger profit on the whole. But most people can't sit in a trade to get that big profit without having that smaller target kind of take some of the stress off and give you some breathing room and allow you to say, okay, worst case scenario, I'm, up a point on the trade. Now I can kind of sit back, be a little more patient, let the thing run, and you're not just, oh, I'm up 2 ticks, I got to hit flatten, or I'm up a point and I got to move my stop to break even. Because if you move your stop too early, especially on something like the ES, you just end up getting taken out right away, and it kind of chops around your entry a little bit. And then by the time it gets moving, you're just, you took a 1 tick profit or a break even profit because you were afraid of the loss, but you're never giving yourself the opportunity to get, even a couple points, let alone a home run. So that's what I have for you today. Thanks for tuning in. If you do have questions, you can always shoot me an email. Put my email on the screen there, tim@eminimind.com. Thanks for David for allowing me to present, and thanks to everyone else for tuning in today.